Many of my friends come to me and they tell me they would like to start to build their investment portfolio. And what they do, the way they start, is they buy a company, a bit of equity in that company they happen to like. Maybe there's a buy-to-let property and they put that in the portfolio. Sometimes there's a corporate bond they feel quite comfortable with, that goes in the portfolio. It's all very ad hoc. Doesn't mean they won't make money, but this is not the best recipe for success. I spent 30 years in investment banking and asset management, and it's now many years since I first built my own portfolio. This is making me good money. My advice is, don't begin this way. Instead, I'm going to give you some thoughts on how I think you can better begin to build your portfolio. In other words, some of the things you should think about before you make that first trade. So the advice is, don't dive right in. Instead, here's my list of 4 things to consider, and we're going to go through these one by one. So one of the first questions is, what are your competencies and what interests you? Now, the reason why I ask this question is because the wealth of knowledge you will need to invest successfully in financial markets could be enormous. On one hand, you may feel as though you'll need to understand individual companies. You'll need to have a good picture of the broader macro environment. To invest in certain sectors of the equity market, for example, pharmaceuticals, requires highly specialised knowledge, which not many people have. If you decide you're going to buy buy-to-let property or even commercial property, how much do you actually know about managing property? It's not as straightforward as it might appear. Or perhaps if you might decide you're going to buy government bonds, and this is really driven as a kind of mathematical exercise based upon the broader economic picture. Not surprisingly, this is therefore hugely challenging, and I do think every investor has to consider, what are my competencies and which of these investments do I think I can reasonably understand? Because if you don't understand it, it's going to be very difficult to manage it yourself, and you may have to pay someone else to manage that asset class. Now, of course, you'll learn more about this over time. So I think one of the important things to consider as well is, where do your competencies lie? In other words, if you're really good with spreadsheets, managing a government bond portfolio is probably not going to be as challenging as it might be for someone who has no concepts of mathematics and is not keen on spreadsheets at all. Similarly, if you're going to look at equity, either you look at it from a very high level, in which case a knowledge of the economics is going to be really helpful, but if you're going to delve down into the companies, then you'll need to know a bit more about accountancy, how balance sheets are constructed. Certainly, if you're buying very early stage startups, you will have to have a lot of knowledge about the industry and about the mechanics of how those individual companies are managed if you're going to make good headway there. Now, of course, all this can be very daunting. It sounds like it's too much you need to know. You shouldn't be fazed by that. I think one can absolutely make money in the financial markets, but you've got to think carefully. First, what am I competent to do? And as I learn, educate myself, how are my competencies likely to evolve? And of course, what do you enjoy doing? Because you're always going to be much more competent at things you enjoy doing. So if, for example, economics really fascinates you, then managing a portfolio where the returns are going to be derived from good economic decisions is going to be much more successful than if you'd really rather delve deep into a company's reports or their balance sheets. So do think about these things very carefully. Rather than buy something because you like the look of it, think, how competent am I to manage that asset, and will I enjoy learning about the factors which drive the asset price and will help me manage it. The next thing you'll need to consider is, are you a top-down investor or are you a bottom-up investor? So let's look at those two terms in more detail and try and get a sense of the difference between them. The top-down investor looks at his portfolio from above and is saying, what should my portfolio look like from a very high level? And they will probably first make decisions about which asset classes they want to invest in. Maybe it's equity, maybe it's government bonds, perhaps it's property. And that will be their first high-level decision. Once they've then decided, for example, to invest in equity, the next decision is, do I invest in pharmaceuticals? Do I invest in tech? Do I invest in some forms of the utility industry? Having then decided what the sectors are within their equity portfolio, they might then drill down further and say, within tech, am I going to buy some of the large, very well-known names, the FANGs, for example, or am I going to buy very small companies? And then having decided that, they will then decide which companies they're going to buy. Frankly, they may not even get that far, and they may buy an exchange-traded fund, an ETF, which will match that particular sector. So they might buy a tech ETF. So the top-down investor works his way down from a very high level. The bottom-up investor looks at it the other way. They're looking for specific investments which they think are very attractive. Now, to use a similar example again from the equity market, perhaps there's a particular company they feel is very, very attractive, and they add that to their portfolio. Then they find another company they find is equally attractive, so then they add that. Now, possibly if they're trading options, this might give them a chance to short companies, and they'll find a company they don't like, and they'll find a way to sell that. This means their portfolio will be a series of different trades. Now, it doesn't mean the bottom-up investor won't look from the top down occasionally. They won't necessarily just leave it like that. They will also try and look top down and see, is the portfolio structure sensible from what I'm trying to achieve? But nevertheless, a top-down investor begins at the top. The bottom-up investor is really starting with the individual companies, or in the case of a fixed income market, the individual bonds. So which one do you want to be? Now, for myself, I'm a top-down investor because my training is as an economist, as an investment strategist, and therefore it's easier for me to take the high-level decisions, and that's where my competency lies. Your competency and your interests may lie elsewhere. So what's appropriate for me may not be appropriate for you, but I certainly encourage you to think through how you're going to be either a top-down or a bottom-up investor, and also not to be top-down to the exclusion of bottom-up or bottom-up to the exclusion of top-down. In other words, if you bought individual companies, at some point you really want to take a bird's eye view and say, do I want to be in the equity market at all? Or if you've bought a top-down portfolio, are the individual companies that I bought the right companies? So think about this very, very carefully in terms of the way you manage your portfolio, because one thing I think is very, very clear. If you start life as a top-down investor, and that's how your portfolio is structured, changing your approach is going to be a very intentional decision and could be quite a bit of work. So I'll get that decision out of the way before you even trade anything. Now, the next decision is which asset classes do you intend to buy? Now, of course, there's a wide range of asset classes out there, and some of them are fairly obvious, like equity or fixed income. Some of them are less obvious. Let's give a bit of thought to those first. So, for example, are you going to be a residential property landlord? Property is quite a good long-term asset class to own. Often it's a good hedge against inflation. But bear in mind, it's a very illiquid asset class and can require quite specific and careful management. Do you wish to be involved in an asset class like that, which is so illiquid, where you can't get your money out if you suddenly need it? For some people, that's no concern. It doesn't bother their financial objectives in any way whatsoever. But there are people who will not feel comfortable with that level of illiquidity and will feel as though property is not the right asset class for them. So, worth looking at that as an asset class. Will I buy it or not? One asset class that I've invested in is classic cars. Again, not hugely liquid. It's certainly very enjoyable to invest in, and I've had a great time choosing classic cars and driving them. Think carefully. Do you have the expertise or know-how to get involved in classic cars, or does it even interest you? There's a good chance it probably doesn't. And in that case, maybe don't go there. Now, of course, equity is probably on your mind as well, and most investors I know will have some equity in their portfolio. Again, you want to think very carefully about how much equity is in your portfolio. Because although this is quite a liquid asset class, or at least publicly traded equity is very liquid, you need to consider that it's also a very volatile asset class. When the price really falls off because there's a recession, for example, although technically you can sell, you're going to be locking in some pretty awful losses if you sell at that time. So timing can be everything in equity, and we'll talk some more about that in another video. So equity is maybe if you feel as though you might need the liquidity, but only in extreme situations. But it is volatile and requires careful management as a result. Government bonds and corporate bonds offer a less volatile asset class, but structurally it's hard to get the same long-term returns, especially if you're a passive investor, as you might get in the equity market. So you need to consider, do you want to invest in government bonds? And does that meet your long-term financial requirements? These are all things you need to consider very, very carefully before you start to make that first trade. Certainly for myself, the percentage I have that is in equity, I try and keep fairly constant over time. And if I'm going to increase it, it's because I've deliberately decided that I want to own more equity. I don't let it rise just because I'm a passive investor and haven't done anything. It's very important to actively make the decision. This is how much goes in property, this is how much goes in equity, this is how much goes in government bonds, and to know why you made that decision. And of course, look at the other asset classes out there that you might find interesting or appropriate for you. But again, be very careful about delving too deep into some of the esoteric asset classes such as artwork or whiskey, particularly if you think they're going to be very illiquid and you're not going to be able to sell them when you need to. I'd put a lot of thought to that if I were you. And here's my last recommendation of something you absolutely must consider before you get involved in actually trading. First, I would paper trade for some months. Now, what do we mean by paper trade? In other words, set up a dummy portfolio. Rather than actually buying what you think you really want to buy, log on the spreadsheet, an imaginary trade. I purchased XYZ at a certain price. And then when you decide you don't like that anymore and you want to sell it, I sold XYZ at a certain price. This is my tax liability, which I deduct, and my costs of ownership. and then over a period of weeks or months or years, decide whether you think you are performing well. Now, if you find that you're simply not competent, in other words, your trades are consistently losing money, you really need to back off actually doing real trades and try and learn a bit more about investing in the markets. If you think you're doing really well, you have to ask yourself the question, why are you doing so well? So here's a question for you. If you've invested in 10 different stocks, you've made money on all of them, they performed really well, but if the whole market's gone up at that time, that doesn't mean you've necessarily chosen the right stocks. And the question you have to ask yourself is, have I outperformed the stock market? In other words, have I chosen the best stocks I could possibly own? Or was I just buying at the right time and selling at the right time? So if you have made money, look at why you've made money and where your competencies lie. Don't be afraid to be self-critical of your own judgment. Obviously, don't undermine your own self-confidence. That isn't a good idea, because then you'll never trade. But try to understand why you've made the right decisions or why you've made the wrong decisions. Now, how long should you paper trade for? That's up to you. You have to decide at what point you have sufficient confidence to go further. Now, I view it in many ways as a bit like trying to pass your driving test. The day you pass your driving test, although you're certified to drive on the road unattended, that does not necessarily mean that you're the world's most competent driver. You need to be very, very cautious and careful at that time. The same, I think, with the day you decide you're happy with your paper trading capabilities and you're going to start to buy real stocks and bonds. Be careful out there, play it safe, and think carefully why you're buying what you're buying and whether your decisions have been good decisions or not. Another thing you can do as well is, if you've got a certain amount you want to invest, don't invest a whole lot in one go. Start with a small portfolio, see how that's performing, and then move on to something different, move on to something larger over time. I think that will be much more helpful than just diving right in, investing the whole lot in one go, because if you're not ready for it, all you're going to do is lose money. So be cautious and safe out there, and do treat it as being a bit like driving a car. You need to have the right processes, you need to be alert, and you need to be confident you know what you're doing. And that confidence and those skills do only come over time. So don't be afraid to paper trades for weeks or months if necessary first. So those are my thoughts on some of the issues you need to consider before you even start to trade. I hope you found this really, really useful. If so, please click like, please subscribe, and there will be more videos coming along soon. If you want more detail, the web address for our website is coming up just in a second, and you'll be able to see details of our paid courses, which will give you much more material on some of the stuff that we covered so far today. Anyway, good luck with the investing. Hope the market performs well for you.